Welcome back to another explainer. Look, if the financial world feels totally overwhelming to you, you're definitely in the right place. Today, we're diving into some absolutely fascinating source material that breaks down the entire financial system and reveals it for what it truly is. It's a game. So let's look at the rules together, figure this out, and start playing to win.
But before we can really start playing, we have to shatter a pretty massive illusion. Money isn't real. It's really just a shared illusion. I know, that sounds completely crazy, right? But the absolute foundational rule of the entire financial world is that currency is nothing more than a social construct. It's built entirely on our shared belief and, well, trust.
Okay, let's dive into this step by step. We're breaking this explainer down into 5 stages. First, the illusion of money. Then, taxes and the middlemen. Third, inflation and economic cycles. Fourth, cracking the credit score. And finally, the winning strategy: time, interest, and investing.
So, starting us off with Section 1, the illusion of money, currency and value.
Think about a dollar bill versus, say, a stick you found in your yard. There's actually no true underlying difference in legitimacy between these two things, other than our collective agreement. The only reason a dollar bill can buy you a coffee and a stick can't is simply because we, as a society, all agreed that the little piece of paper is worth something. Now, obviously, central banks actively regulate this money supply so it doesn't just turn into worthless monopoly money, but at its very core, it's all about trust. And we can actually use this shared illusion to our advantage. Mastering the game means understanding exactly how value is created, because honestly, it's all about perception. I mean, why is gold worth so much more than an average rock? Well, it's rarer, sure, but mainly humans just decided to place a higher value on it. Why can Gucci charge 100 times more for a handbag than Target? Perceived brand value. It's that simple. If you provide massive value out there in the real world, whether it's through high-value services like doctors and lawyers, or creating massive utility like Steve Jobs did with the iPhone, you are going to earn a lot of money. People will happily hand over their paper illusion for the real value you provide. Which brings us to a rather painful question. If money is really just a belief, why does the government take so much of it? Let's transition from the fascinating philosophy of value over to the definitely less glamorous reality of taxes. Moving on to Section 2, Taxes and the Middlemen, the Cost of Civilization. Welcome to the modern ritual of taxes. You slave away at work, you finally get paid, but these invisible forces literally take a chunk out of it before it even hits your bank account. But, this is the cost of civilization. These different tolls we pay, income tax on the money you make, sales tax on the money you spend, and capital gains tax on those investments you make while you sleep, they pay for our roads, our schools, and they basically ensure your favorite taco truck isn't infested with rats. We've also got forced retirement savings through Social Security and health insurance support via Medicare. The funniest and honestly most perilous part about all of this, the government usually knows exactly what you owe them, but they still make you guess when you file, and if you guess wrong, you're pretty much cooked. Which brings us to the other middlemen on the board, the banks. Look, most people think banks are these giant, dragon-guarded vaults where your cash just sits around gathering dust. Not at all. They're basically financial matchmakers. It works through something called fractional reserve banking. Here's how it goes. You deposit your $1,000, the bank keeps a tiny fraction of it in reserve, and then they lend the rest, say $900, to some guy who really, really wants to buy a jet ski. Basically, you are the supply, and that guy over there, the borrower, is the demand. But while your money is just sitting there in that bank account, a new hazard is approaching. Seriously, what happens when the money in your bank account slowly starts losing its power? That drops us right into Section 3, Inflation and Economic Cycles, the Invisible Hazards. The absolute first hazard you run into is inflation. It's the slow, steady erosion of your money's value over time. Your $5 bill technically stays a $5 bill, right? But suddenly it's buying you way fewer instant noodles and a lot less gas. So why does this happen? Well, sometimes there's just too much cash chasing around too few goods. Like if everyone suddenly wants a new TV, the store is going to raise the price. Other times, supply chain hiccups just make producing things way more expensive. Now, a little bit of predictable inflation, say around 2%, that's totally normal. But when it spikes, your savings get crushed. And when that happens, the government steps in to fight it by raising interest rates. They basically make borrowing super expensive to cool down all that frantic spending. But when things cool down a little too much, we hit our next hazard, a recession. This is an economic reset where the economy actually decreases for at least 6 straight months. Think of an economic boom like this amazing party. Everyone's dancing, everyone's spending freely. Well, a recession is the exact moment the harsh lights flicker on, reality hits, the DJ switches to sad lo-fi beats, jobs vanish, and everyone's spending drops strictly back down to the bare necessities.
So, with all these massive macroeconomic waves crashing around us, we kind of have to look inward for a second. How do lenders decide if they can actually trust you with their money during all of this chaos? That brings us to Section 4, Cracking the Credit Score, the Shadowy Algorithm. Let's take a look at how the source material lays out this very shadowy algorithm to see exactly how you build what is basically adult credibility. Look, lenders just want to know one thing. Will you pay them back? And they calculate this using 5 things: your payment history, your credit utilization, which is just credit used versus what's available, the age of your credit, your mix of different loans, and how much new credit you're currently applying for. Now, the absolute crucial point here is this. Your payment history is the biggest factor by far. You must make your required payments before entering the late period. Think of your credit score like a pet dog. If you ignore it, it's going to make a huge mess of your life, but if you take care of it, it'll literally help you buy a house. And all of that algorithm math just boils down to this concrete benchmark range, 300 to 850. If your number sits below a 580, well, to a bank, you are a walking red flag, no way around it. But if you're sitting pretty at over 750, you are absolutely sparkling with adult credibility to them. Now, you might be looking at all of this, the inflation, the taxes, the credit algorithms, and you're probably thinking, man, this game is completely rigged. And you know what? Yes, it kind of is. But that leaves us with one really big question. How do you actually win a rigged game? Simple. By learning the rules so well that you can rig it right back in your favor. Which brings us to our final section, Section 5, Time, Interest, and Investing, the Winning Strategy. The ultimate cheat code here lies in the incredible duality of interest. See, when you borrow, interest is essentially the price tag for using someone else's cash. If you're carrying credit card debt at, say, 20%, that interest is literally cloning itself against you, turning small mistakes into massive financial fires. I mean, your $12 burrito quickly becomes a $50 regret. But on the flip side, when you invest and you are the one lending your money out, interest becomes your reward for being patient. Investing at historical averages, like a 7% compound growth rate, acts as a wealth-duplicating cheat code. It turns your small, consistent gains into massive, massive wins over time. So how do you actually start earning that reward? Well, you have to stop trading your limited time for a paycheck and start trading your money for more money using this investing arsenal. First, you can buy stocks, which are just tiny ownership slices of growing companies. Second, you can buy bonds, which is essentially you loaning your money out in exchange for interest. Third, you can buy funds. These are super convenient collections of stocks and bonds all bundled together so you don't have to pick them one by one. Or finally, you can invest in real estate, owning property that other people literally pay you to live in. But honestly, the real magic isn't even just in what you buy. Time is the ultimate multiplier in this game. Look at the timeline. At 10 years, your money slowly, steadily grows. At 20 years, that multiplication speeds up drastically. And at 30 years, that compound growth can literally create 7-figure wealth. This right here is exactly how ordinary people with perfectly modest paychecks manage to retire rich. They didn't somehow beat the system, they just used the system, and they gave it decades to do the heavy lifting for them. Which leads us to this incredibly powerful takeaway quote from our source material. The real danger isn't losing money. It's never investing and watching inflation quietly steal your future. Seriously, just let that sink in for a second. Avoiding the game entirely is the only guaranteed way to lose it. You literally have to participate. And that leaves us with one final, totally vital thought to end on today. Interest is either your absolute worst enemy or your very best unpaid employee. So who is collecting yours? Are you paying it out to credit card companies, or are you making it work for you? Take a quick mental inventory of your own strategy today. Thank you so much for joining me for this explainer. I really hope this helped demystify the game for you, and I'll catch you in the next one.